Hello and welcome to the program. I'm Will Ibang. First things first, let's check in on the market, starting with Africa, where equities traded mostly positive at intraday. Nigeria's NGX jumped 1.84% at intraday, while South Africa's index tumbled 1.27%. Elsewhere, Egypt's EGX30 was marginally up by 0.02%, while Kenya closed Wednesday's session in positive territory, up 1.26%. In the Middle East, it's a bloodbath at intraday. The Abu Dhabi index fell 0.06%, while the Dubai exchange dropped 0.28%. Meanwhile, still within the region, Saudi Arabia was down by a massive 1.7%. while the Qatari index declined by 0.84%. Now we'll move over to Europe, and and same as anywhere else in the world, it's only 6 weeks until Christmas. And with the holidays approaching, retailers have entered the most important season of the year. But concern among businesses is rising that facing sharply increased food and energy price, people are going to cut down on their holiday spendings. And yes, DW's Chris Colbert with more details. Chris, how likely is it that people are going to do just that, just spend less?
It's quite likely, not least because of the results of a recent YouGov poll. It stated that more than half of the people surveyed say they were going to spend less money on Christmas presents this year, or none at all. And there's a second survey supporting the sentiment. In a poll conducted for Germany's Postbank, about 20% of people asked said that they would spend significantly less on presents. Another 22% said that they would spend slightly less, and 8% said they would not buy any presents at all this year. So record inflation that has been above 10% in the past 2 months has really been biting its way into people's minds and budgets, with prices for energy up by more than 40% compared to 1 year ago, and the prices for food more than 18% higher. And retailers shouldn't expect cuts only when it comes to selling Christmas presents. A quarter of the people surveyed say they would reduce their Christmas lighting. Around 20% say they wouldn't get a Christmas tree this year, and around 17% say they were going to spend less on food during the holiday season. Now, we should note that around a fourth of the people surveyed say they wouldn't change anything about their consumption over the upcoming holiday period.
So a bleak Christmas, looking like a very wintry Christmas. How has the financial situation for people in Germany changed in recent months, Chris?
November 2021, so 1 year ago, inflation in Germany noted above 5% for the first time in years, and it has been reaching more than 7% since March. So people here have been facing rising prices for quite some time now. And the number of people who are having trouble financing their daily expenses has also been growing. In January, 11% in the Postbank survey said that they had serious difficulties in paying for daily necessities. Now, that number has increased to 18% in September, so almost a fifth. And the prospects going forward isn't much promising either. Almost 2/3 of those polled expect their financial situation to deteriorate in 2023, which is a figure not reached since the introduction of the survey 7 years ago, pollsters say. Now, when asked the same question last year, only 23% were that pessimistic. There is, of course, hope that the anticipated recession won't be as bad as some project. Germany's Council of Economic Experts, who are also advising the government, are expecting the economy to contract by only 0.2% next year. We talked about that yesterday. Now, that is a slightly more optimistic prediction compared to the government's. Nevertheless, high prices are very likely going to remain an issue that people will have to deal with.
No, we just hope that recession doesn't bite so hard, because we can't imagine Christmas without a Christmas tree. Now, so give us a quick market update, Chris.
There's not much swing today so far in today's trading session before U.S. inflation figures are coming out later today. In trying to tame a record inflation in the U.S., the Federal Reserve has already hiked its key overnight rate to a range of 3.75% to 4%, up from virtually zero in March. And more investors are expecting it to top 5% next year. Now, a softer reading than expected of the figures could give the Fed leeway to loosen up a bit. Economists expect the report to show a continued slight moderation of inflation from a peak set during the summer, but a worse than expected reading could have the opposite effect. Now, so far, investors are holding their horses. The DAX in Frankfurt trading slightly lower, down around 0.5% in the early parts of today's trading.
Thanks so much, Chris, for the update. We'll look forward to more tomorrow. And now, still speaking of cuts, the UK government plans to cut surcharges on bank profits. And Channel's TV Juliana is right there in London to fill us in. Juliana, UK plans to cut the surcharge on bank profits to 3% to keep the industry competitive. How is that going to work out?
We'll just have to wait and see. Good afternoon, Will. This is all part of another leak, because we've had several leaks over the past couple of weeks in the run-up to Jeremy Hunt, the UK Chancellor of the Exchequer's autumn statement, which is going to be taking place in precisely 7 days. Jeremy Hunt and the Prime Minister, Rishi Sunak, have a huge task on their hand in trying to plug the £60 billion black hole, which, of course, was thrown open during Liz Truss's tenure. And now Jeremy Hunt has been speaking to the City of London professionals, as well as bringing in an old face that's really pretty notable here, which is George Osborne. He was Chancellor under David Cameron's tenure. And so this bank surcharge was actually introduced in 2015. At the time, David Cameron was Prime Minister, when we had a hung parliament. It was a coalition government with the Liberal Democrats, and it was put in place at 8% on top of corporation tax to stop and prevent banks from profiteering, because corporation tax was reduced at that time. We do believe that next week corporation tax will be increased to stick with Rishi Sunak's plans when he was Chancellor, and because it is going to be increased, banks would therefore be disproportionately targeted. So the surcharge is apparently going to be downgraded, reduced from 8% to 3%. But again, Will, as with this Conservative Party, we're not certain. These are all leaks that have been, passed out to the media. So we'll just have to wait and see those famous words.
We'll definitely wait and see. Now, a growing disenchantment is still trailing Brexit. Now, next CEO, Lord Wolfson, says, and I quote, "This is not the Brexit I wanted." Can you tell us what he meant by that?
Yeah, this is interesting, actually. Lord Wolfson, he is a Conservative peer who is known as the chief executive of Next, which is a huge retailer in the UK. They've done exceptionally well. They've been one of the few retailers that were doing very well before the pandemic, did exceptionally well during the pandemic, and is still doing well. He is a very prominent businessman here in the UK, and he is known for being a Brexiteer. During the 2016 referendum, he was very much on the get us out of Europe. So I think it's going to be very difficult to find any sympathy or anybody listening to him saying we should reverse some of the principles of Brexit, which was basically to stop the free-flowing movement of people across Europe. Since that's happened, we have seen that net migration has fallen. We're not talking about dinghies coming over from the Channel or other kind of work-related visas. We're talking about net migration. It has reduced significantly from Europe, according to data from the Office for National Statistics. And that is because of the open door policy. It has been shut. And now this is, of course, affecting the labour market. We are going to peak festive period. I heard you speaking about Christmas, with our German colleagues. And, retailers do want a lot of staff. It's going to be difficult to get the staff because they used to to rely on seasonal workers that came in from Europe. They're not here. So Lord Wolfson was speaking to the BBC earlier today. He believes that there should be a relaxation of net migration coming from Europe, and that if retailers want to benefit from these staff, then they can pay an additional 10% tax of their salaries to the government. But I think there's a lot of closed ears when it comes to anything about reversing Brexit coming from Lord Wolfson.
I think I see double standards at play here, wanting one thing and then saying you want this the next minute. He should take, I think he should just take a stand. What does he want? A firm stand. Are you for Brexit or not for Brexit? I think that's what we're looking at. Now, how are markets looking at intraday? Are they looking good, Juliana?
Not looking great, unfortunately. That's because of a fall in commodities. Oil is down. That's dragged down the mining stocks too. So at intraday, the all share is down 0.34%. The FTSE 100, that's down by 0.35%. And the FTSE 250, the domestic market, well, that's down by 0.28%. In the currencies market, the British pound is currently rallying. It's rallying against all major currencies at intraday. One British pound will buy you $1.13 and it will buy you €1.14 as of now.
Thanks so much, Juliana, for the update. It's always good to speak to you. And now we'll move over to Asia, where stocks were negative on Thursday as investors await CPI data from the U.S. The Hang Seng Index in Hong Kong lost 1.83%, while in mainland China, the Shanghai Composite shed 0.39%. The Nikkei 225 in Japan lost almost 1%, while the Kospi in South Korea declined 0.91% to close. In Australia, the S&P ASX 200 fell by 0.5% to end its session. Now we'll move over to the U.S., where stock futures rose in early trade on Thursday after recording triple-digit losses in yesterday's trading session. Investors still have their eye on the consumer price index expected today. Futures tied to the Dow Jones Industrial Average rose 0.05%. S&P 500 futures edged up 0.11%, and Nasdaq 100 futures gained 0.24%. Now to the oil space, where prices, oil extended losses in early trade on Thursday for a fourth consecutive session as renewed COVID curbs in China, the world's biggest crude importer, weighed on the market, and traders await U.S. inflation data for clues on further interest rate increases. Brent crude futures fell 0.4% to $92.24 a barrel, while U.S. West Texas Intermediate WTI crude futures were down 0.6% at $85.35 a barrel. Brent prices have dropped more than 6% so far this week, while WTI is down more than 7%. Now, gold prices inched up early on Thursday as markets' focus remained on U.S. inflation data expected today. Spot gold rose 0.09% to $1,707.85. $1,707.85 per ounce. U.S. gold futures fell 0.3% to $1,708.60. Spot silver rose 0.4%. Other precious metals, platinum rose 0.31%, while palladium fell 0.58% to close. The global price of natural rubber is falling sharply by 28% to $127.07 per kilogram from $178 per kilogram at the beginning of the year. The global energy and commodity prices index has increased by an average of 40% this year. Well, Oluwatomi Mayowa, senior analyst, Financial Derivatives Company Limited, joins me to discuss the reason behind this and more. Good afternoon, Mayowa. It's good to have you on the program.
Thank you very much.
What are the major reasons behind this for the fall at a time when we've seen soaring energy prices and commodity prices are just rising in general? Why is rubber falling?
Thank you very much. I would start by saying that one thing to note is that China is actually the largest consumer of rubber, and it accounts for about 60% of total world consumption. And so as a result of the zero COVID policy in China, we've seen that their GDP growth have actually slowed by about, it's slowed. I think it's around 3%, an average of 3% in 2022, compared to an average of about 7% before the COVID. So as a result of that, demand has actually fallen. If China, which accounts for about 60% of total consumption, is having slow growth, that would also have an impact on demand, and also for European countries, which is also the fifth largest consumer of rubber. They are currently facing slow economic growth, inflation, high inflation, and high interest rates. So all of that are actually contributing to that decline in demand, and that's why we're seeing the decline in the price of rubber also.
I do know, though, we do all know that Nigeria is in the league of the global producers of rubber, but we've seen an underperformance in Nigeria's agricultural sector when compared to other African countries. Why would you say, what is the reason for this, in spite of the fact that we have similar climate conditions? Why are we underperforming?
Yeah, I would start by saying, starting from the fact that the time when Nigeria discovered, it's all coming from when Nigeria discovered oil. Agriculture used to be Nigeria's source of income, but we are seeing, as a result of that discovery of oil, there was a shift there was a shift actually, and as a result of that, the focus, they were not able to develop the agricultural sector. What we should have seen actually should have been that the proceeds from oil should have been directed to the development of the agricultural sector. But that has not happened because the funds are being used for other things that, we're not, at the end of the day, we're not productive. So we are now talking about diversity. Now that the oil sector is actually underperforming, we're now talking about diversifying, our source of revenue. At a time where our debt is actually increasing at a faster pace. So everything is actually causing this difficulty. Another thing to actually note is the fact that we are also, at the moment, our fertilizer outputs have actually increased, but because of the forex structural defects, this defect in the forex market, we've seen that most distributors are actually smuggling out this fertilizer to other African countries. And so while we are seeing that output increase in agriculture in other African countries, it's deteriorating in Nigeria. So this is what has been the issue in the agricultural sector in Nigeria.
And so what do you think, in your opinion, are the policies, the measures that the government in Nigeria can take to turn this situation around?
Taking, for example, Ivory Coast, because agriculture was actually their mainstay or their source of income, they were able to focus on ensuring the development of that sector. And, there were constant investment in that sector, ensuring that, funds were channeled to that sector to grow the sector. So it's better late than never for Nigeria because we can, the funds that are being borrowed, the money should actually be channeled into the agricultural sector, not, borrowing to pay your debts. So that when we see that with the growth, that would actually buoy growth in the agricultural sector, and also, eradicating the bottlenecks, in terms of land acquisition, and also securing land titles and tenures for especially farmers, and planting more rubber trees to boost production in the sector.
Okay, thanks so much, Oluwatomi Mayowa, Senior Analyst, Financial Derivatives Company, for sharing your perspective on the program.
Thank you very much.
Welcome back. We'll pick up from Uganda, where the Bank of Uganda has revealed that the country's public debt has hit 80 trillion shillings, which is 50% of the gross domestic product as GDP. The revelation raises concerns on whether Uganda is able to meet its debt repayment obligations. The central bank says that although the debt is still sustainable, the bank is cautioning Ministry of Finance to ensure that all commercial loans obtained by government have a grace period of at least 5 years going forward to avoid putting pressure on the foreign reserves. The IMF and the World Bank have urged countries to ensure that their national debt never exceeds 50% of their GDP. Move to Angola, where the Angolan central bank has fallen. The Angolan's foreign reserves has fallen to 11-year low as the central bank revamps its data. The lender attributes the decline to a new method of calculating holdings. The Banco Nacional de Angola's reserve fell to $13.46 billion in October, the lowest level since at least December 2011. However, the central bank expects reserves to remain stable after the drop. Now to Kenya, where the country says it will be the biggest producer of Africa's cheapest smartphones in the next 8 to 12 months. And that's according to the country's President William Ruto at the annual general meeting of the Kenya National Chamber of Commerce and Industry. Mr. Ruto says the government are in discussions with telcos and are also exploring the possibility of having the smartphones sold below 5,000 shillings. He also said that his administration is looking at having all government services online in the same period, including the use of digital platforms in tax collection. And that's it on Business Incorporated. Thanks for watching. I'm Will Ibang. Bye for now.